We like people talking. It's been too long between speakers. As you enjoy your names, and I hope you all are, I would like to invite Paul Saunders as the opening speaker for this evening to talk about views for 2010. And just a short preamble about Paul. I've known him for a few years. A man whose views I respect greatly. And he works for a bank. But I'm not here to, we don't doubtlessly push any particular broker or bank or product. It's an open forum. But Paul has very kindly, I better slow down my introduction because I think he's still getting through his main. But he's a man of great experience who seriously I have a great deal of respect for his views and opinions on the markets. And I invite Paul Saunders to share his thoughts on the markets and the trade idea for 2010.
Thank you very much, Nigel. That stage is beautiful.
In front of the
Thank
floor.
you very much, Nigel. And I thank you for the opportunity to speak to the wider team today. I've been asked to spend sort of 5 or 10 minutes talking about what we think might happen for the rest of this year and next year, 2010. I think we've struggled to work out what's going to happen between now and the end of the week, let alone next year. but my theme, 10 minutes will be buying glue, selling glue. Not particularly original, but been very successful over the 13 years I've been involved in financial markets. Buying glue, selling boom. Buying glue, selling boom. Earlier this year, you may have heard me speak about Iceland, and we had a situation with mainstream press reporting, I think it was in February, March this year. Iceland's a terrible place, don't go there. Huge debt, currency falling through the floor, don't go there. It's in the mainstream press. Ideal opportunity to invest. Buying glue, selling glue. Since February this year, that currency's actually appreciated, what, almost 20%, I think at one stage it's 25%. 20% appreciation, and government bond has dropped from 18 to 11. So, clearly there's value in buying something, some asset, some currency, which everyone else is willing to, or unwilling to buy. Most people will shun. So my theme this evening is looking around the world, what's out there that we can look forward to 2010 to make some readies. Every time I turn on the television screen, all I hear about is buy gold, sell US dollars, buy equities. The uniformity of view. Buy China is another one. So my theme for this year, or for next year 2010, is buy US dollars. Buy US dollars. Against what? Well, it's being a Tom, I guess, and to slide from the wider Europe. We'll buy US dollars and sell euro. So we'll buy US and sell euro. Why? Not just because we're being smart arse. Contrarian. But a number of, I picked out 3 or 4 things that I thought was quite key to why we might get some value and make some money taking this contrarian view buying US dollars. So I've focused on debt situation, particularly in Europe, gold. I don't profess to be any particular expertise on gold. Equities and China. I think those 4 key areas. I'm sure we'll talk more about those later on in the evening as the evening unfolds. But let's just look, if we're going to go long US and short euro going forward next year, let's start with Europe. The debt situation. I think Nigel, you somebody touched on Dubai earlier this evening. We've just seen the tip of the iceberg now. Dubai, 80 billion US dollars, is it? They're seeking a debt moratorium. 40 billion of that is owned by European banks. European banks, absolute disaster. I was having some figures I was looking at before I come here this evening, just having a look at where is the next Dubai, and it's really quite scary when you start looking at the level of indebtedness other countries around the world have, and who's lending the money. I think Russia, I unearthed, has something like 200 billion worth of foreign debt, most of it owed to European banks. Greece, I think, was another one, 100 billion. Again, European banks have lent to the likes of Greece. So we have a ticking time bomb here in terms of what Europe has done to lend to the wider world. So Dubai is just the tip of the iceberg. So I just like the euro for that reason. Those that follow equity markets and follow gold, you'll see that a tremendous correlation between the euro and the gold price, the euro and the equity price, the Dow Jones or the S&P, whichever you like to use. As the gold price goes up, the euro goes up. As the equity markets rally, the euro rallies. So let's focus on one of those. The equity market, S&P, great example. Now trading at 22 times earnings, PE of 22. The highest it's been since 2002. I can't believe that companies in the US are going to be able to deliver the sort of earnings based on a PE of 22. So very concerned about equity prices going forward, and if there's to be a correction early next year, then equity prices for the S&P will deliver that through those corporate earnings being able to deliver profits. The gold price versus the euro. The gold price goes up, the euro goes up. Obviously that's a contra US dollar view. How much further can this gold price go? I appreciate gold's been in a rally for 10 years now, but we're seeing gold, those of you that can remember back as far as 2007, that's not that far. Gold went from $600 to $1,000, and then a year later it was back at 600 again. So be very careful about buying gold at $1,225 an ounce here today. It's spent a year going from 680, it's doubled in a year, it's doubled in price. So be very careful about, I think, piling into gold. Although I appreciate longer term, 2,000, 3,000 certainly may be appropriate in 5 to 10 years. But for 2010, I think not. So debt, equities, gold, China. China's an interesting one. Again, China, everybody loves China. Even my employer, who will not please, we love China. The oversupply, I think, that's developing in China is a great concern. The Chinese, you've been aware the last 12 months, I think they pumped something like $900 billion into that economy. It's a $4.3 trillion economy. It has had little or no effect. Those of you that travel up there regularly will know that commercial real estate, I think the occupancy or the vacancy rates are 50% and falling. So clearly there is an oversupply issue here. I have a Chinese colleague that tells me that, in fact he stumbled upon this and alerted me to it, but if you look at Chinese car sales, they're going through the roof. Fleets of cars are being sold. But then if you look at petrol consumption in China, it's actually going down. It's either the same or going down. So where are all these cars going? I'm sure all of my suspicions are being parked in some great massive car park out in the middle of the Mongolian desert somewhere. I'm going to investigate and find out what that's all about. But now China's been very, very good at gearing up, not only of course has it been building up resources and sucking out commodity after commodity. I mean, I printed some of these off earlier. You know, copper up 89% this year, lead up 82%, palladium up 76%. I mean, it's just phenomenal the increases we've had in those commodity prices. I can't see that being sustainable. I mean, even things like cement. I mean, the oversupply that must be there. So I see that you know, in a Western world that's clearly heavily indebted. It's not going to be able to buy this sort of stuff. These raw materials that have been sucked out and given to China to produce this, that, and the other. I struggle to see how we're going to be able to consume whatever it is they're going to produce with all this stuff that they've acquired. So how will that manifest itself in? I think it will manifest itself in some sort of rebound in the value of the American dollar over the next 12 months. And the euro I've selected as the contra currency purely because of the disbelief I have in the European banking system and the level of debt that's probably contained therein. The fact that I'm a pawn and Britain still refuses to join the euro. It's got nothing to do with it. But those are the sort of things, sort of themes there, Nigel. I don't know, there's 3 or 4 things I wanted to cover. So.
You know, Paul, I don't know if you're open to questions, but maybe we should just have the speech and actually. I think if you're willing, Paul, to what I should say is that Paul comes along here freely tonight and is not paid for his speaking engagement, and they're just personal opinions. But I think, Paul, if you don't mind, if 1 or 2 people had a rebuttal from the floor, would you mind answering a few questions?
No, certainly not. Any gold traders here?
Oh, I see it. I see it. Well,
it's about British pound. Where do you see that going since you're from?
Goldman Sachs issued a report yesterday to buy sterling and sell Kiwi dollars. I like Goldman Sachs. They have no competition. They have such a stranglehold. They have the Fed in their ear. I like what they say. I follow them very closely. I hear about the British pound, obviously like the US dollar, death and damnation, quantitative easing, 0 interest rate policy. It's going to hell. I don't. I like the pound. I like the pound purely not just be contrarian, but I still think there's a place for investment money outside of Europe, as in the euro. And I think Britain will celebrate the day that it didn't join the euro per se. We may have to grin and bear a wee bit. We got to 46.70 against the Kiwi, didn't we, a month or 2 ago? But I believe the pound is still. Needs to remove Gordon Brown first, I think.
Hopefully it's going with it.
So we like pounds.
No, I like Kiwi. Different things.
My question will sound more like a statement, but it becomes a question. Gold is a hedge against inflation. Equities retain value in an inflationary environment because they are the productive resources of the country. Commodities are valued in dollars, but when the dollar is being printed in vast quantities, what does it matter what the PE is or what the actual price of a commodity is today? Because the inflation it's being guarded against is around the corner and it's obvious.
Yeah, I would take odds that the printing money, that all the Fed is doing, of course, is replacing what the private sector has lost or is unable to lend. So while we read about money supplies expanding, look at M1, look at M3, in reality, I think the increase in money supply is quite negligible because so much wealth has been destroyed in the private sector. So I don't see, there's so much debt in the private sector, be it residential mortgages or whatever. Interest rates are going to have to be kept low and lower for longer and longer. And that will, I think, will ensure that US Treasury yields stay low, that there's no inflation. I just cannot see it, you know, that this collapse in commodity prices in 2010 will ensure that, not collapse, but...
Okay, I'll take your point just about the fact that this money that's being printed actually is replacing money that was in the system prior. That changes the whole equation.
Yeah, I think China's a good, not China, Japan is a good example, because I fell into this trap in the 80s, and Nigel, you would have been...
Middle-aged back then, yeah.
You know, when we saw China, we saw Japan.
We've seen it before.
We've seen quantitative easing before. I mean, Japan has issued, you know, fiscal stimulus after fiscal stimulus, and yet that Japanese economy staying moribund for 10 great
Word of the night, person for
10 years. I mean, you'd even say now, I mean, Japan's in risk of going into deflation again. That because the money just doesn't get spent, you know, and I think that's where we're going now, is that people are so scared. Well, they wouldn't be buying gold if they weren't scared, would they? But I have a few silver bars hidden under the mattress at home.
You know what, I think we've got to keep proceedings rolling tonight, but I think one quick question over there, we'll finish it off.
Well, with the potential problems you see in China, how do you see that affecting the Australian dollar? Do you see the dollar staying up because they've got the interest rate differential than everyone else? Or do you see them falling that they won't be able to continue to sell the commodities?
No, I think the thing about Australia is it's great at selling. It doesn't add any value to what it just digs out of the ground and sells it, doesn't it?
Yes.
So I think if demand slows down, obviously for X, Y, Z, commodity digging out the ground, clearly the Aussie dollar has to correct.
A quick question and a quick answer. Very good. Please, ladies and gentlemen, I'd like to